बिस्मिल्लाहिर्रहमानिर्रहीम। अस्सलाम वालेकुम फ्रेंड्स, उम्मीद करते हैं कि आप सब खैरियत से होंगे। फ्रेंड्स, आज के सेशन में हम डिस्कस करेंगे व्हाट आर इंश्योरेंस लिंक्ड सिक्योरिटीज़। वीडियो की तरफ बढ़ने से पहले हमारी आपसे रिक्वेस्ट है कि हमारे चैनल को सब्सक्राइब कर दें। चलिए आज के सेशन की तरफ बढ़ते हैं। वन कॉमन टाइप ऑफ द इंश्योरेंस लिंक्ड सिक्योरिटीज़ विच विल illustrate many of their characteristics are catastrophe bonds. CAT bonds for the short. If a sponsor such as an insurance company or reinsurance company, a company that reinsure insurance companies, wants to transfer some or all of the risk it assumes in insuring a catastrophe, it can set up a separate legal structure, commonly known as Special Purpose Vehicle (SPV). Foreign governments and private companies also have sponsored CAT bonds as a hedge against the natural disasters. The SPV issues CAT bonds and typically invest the proceeds from the bond insurance in low-risk securities. The collateral. The earning of these low-risk securities as well as the insurance premiums paid to the sponsor are used to meet periodic variable rate interest payments to investors. As long as the natural disasters covered by the bond where a windstorm in Europe or an earthquake in California does not occur during the time investors own the bond, investors will receive their interest payment, and when the bond matures, their principal back from the collateral. From CAT bonds generally mature in 3 years, although terms range from 1 to the 5 years depending on the bond. If the event does occur, however, the sponsor's right to the collateral is triggered. This means the sponsor receives the collateral instead of the investors receiving it when the bond matures, causing the investors to lose most of all of their principal and unpaid interest payments. When this happens, the SPV might also have the right to extend the maturity of the bonds to verify that the trigger did occur or to process odd and added insurance claims. Depending on the bond, the extension can last anywhere from 3 months to 2 years or more. In some cases, CAT bonds cover multiple events to reduce the chances that investors will lose all their principal. Because CAT bonds holders face potentially huge losses, CAT bonds are typically rated non-investment grade by credit rating agencies such as Fitch, Moody's, and S&P. Non-investment grade bonds are also known as the highly yield or junk bonds. These rating agencies as well as the sponsors are underwriters of the CAT bonds, rarely heavily on a handful of firms that specialize in modeling natural disaster. These catastrophe risk modeling firms employ the meteorologistic and and seismologists, statisticians, and other experts who use large databases of the historical or simulated data to estimate the probabilities and potential financial damage of the natural disaster. Here is trigger happy. Each cat bond has its own triggering events, which is are spelled out in a bond's offering documents but may only be available to purchasers or potential purchasers. Different types of the triggers have developed, some of which are listed below. Bear in mind that the question of whether a triggering event occurred or the true meaning of a triggering event can be complex and could wind up being litigated and require a ruling from a court. This is turn may add additional uncertainty to the way these securities perform. For example, although in our distant memory there are property insurance lawsuits following 9/11 that centered on whether the attacks on the World Trade Center counted as one occurrence or two. And there are modeling risk. Price yields and rating of the CAT bonds rely almost exclusively on complex computer modeling techniques, which in turn are extremely sensitive to the data used in the models. The quality and the quantity of the data vary depending on the peril and region being modeled, for example, incorporating climate change. Liquidity risk. Secondary trading for the cat bonds is limited, so in pinch, an investor may not be able to sell. In addition, the secondary transactions that do occur are privately negotiated, so pricing information is not generally available to the public. Remember also that the majority of these some cat bonds can be extended during the worst possible time. When a trigger may have occurred, this can cause the bond's value to the plummet, making them even harder to sell. Here is investments. Most cat bonds are issued in what are called Rule 144A offerings, which are available only to large institutional investors and are not subject to the SEC's registration and the disclosure requirements. As a result, many of the normal investors' protection that are common to most traditional registered investments are missing. For example, issuers of the cat bonds are not required to file a registration statement or periodic reports with the SEC. फ्रेंड्स, ये था हमारा आज का सेशन। मिलते हैं नेक्स्ट वीडियो में। अल्लाह हाफिज़।